What's up, audit fans, and welcome to our very last topic. You've made it, so let's get into it. So what are we going to cover in this topic? Well, we're going to look at 5 things. Firstly, about collating our audit findings, bringing all of our audit evidence together. Then we're going to look at negotiating audit adjustments with the client. This isn't something that's talked about in textbooks a lot, but there's a lot of organizational psychology that goes into how do we negotiate the adjustments with the client. Then we're going to look at preparing the audit opinion. We're going to look at the different types of audit opinions and when you choose each option. We're going to look at determining key audit matters, which is a relatively new task for auditors as part of audit transparency. And then we're going to look at preparing the management letter, which is sort of like the bow, finishing up our audit and presenting all of our findings and all of our information to those charged with governance. So let's start with the context. And today, in terms of the context, we know that we have something called the audit report, all right? And that's the final output of everything that goes into the audit. We know that we need to consider going concern in here. We may need to have disclosures about sub-events. We know that we have to give our opinion based on the evidence about whether the financial statements are free from material misstatements. And everything that we've done leading up to this point, all of our work related to audit strategy, which helps us generate our plan and our audit procedures to gather evidence. All right. We know that our evidence has to meet the assertions. And to collect that evidence, I know that I need to use a whole range of different procedures. Remember my 9 procedures? And, oh, I already have procedures down there, so I've sort of got it twice. Let me remove this one here, since we don't need that one, and that my procedures have options to test systems of internal control or substantive procedures. All right, and we gathered all of this information about how to generate audit strategy from our audit planning. And remember, our audit planning is all about that work from ASA. Oh, that's a bit messy. Let me rewrite that. ASA 315. All right, and all of that feeds into this process. So today we're actually going to look at what goes into our audit report, the process of how we get from our list of material misstatements into what is the audit report. And what we haven't talked about yet is that audit report contains a couple of different things. It contains the opinion that we need to give. It might have some additional information in terms of emphasis of matter or other matter disclosures. It might have going concern information about material uncertainties. And we'll also talk about key audit matters. So we've come full circle from this idea of needing an audit, or firms that need an audit for an ASX listing requirement. We know that audits are about adding, oh, I can't spell here. Let me try that again. Audits are about adding credibility to information and then also increasing the reliability for decision makers. And remember, those decision makers are the ones that eventually get our report are our shareholders. So let's look into collating our audit findings, some sort of summary of the misstatements that we found. So ASA 450 says that we have to evaluate the audit misstatements identified during the audit. And this is a really interesting standard because normally we have our standards on planning are in the 300s, then we have this at 450, and then we have evidence at the 500s, and then the opinion at the 700s. So this is almost like an auditing standard that's a little bit out of sequence, but ASA 450 is the one that we need to look at here. And it says, well, what exactly are included in misstatements? So it says here, misstatements are they mean a difference between the reported amount, classification, presentation, or disclosure of a financial report item and the amount, classification, presentation, or disclosure that is required in accordance with the applicable reporting framework. Now that part there, where it does say the applicable financial reporting framework, really what they're saying there is this is what is the audited amount, all right, or disclosure or classification. So it's really the same words here because it says amount, and you'll see amount down here, and then it says classification up here, classification, presentation, presentation, disclosure, disclosure. So we're really saying reported, and when we say reported, we mean these are the ones prepared by management versus the ones that the auditor has identified from doing their work and collecting their audit evidence. So during the audit, we have to accumulate misstatements identified during the audit other than those that are clearly trivial. So clearly trivial is rounding a couple of cents here or there, a couple of dollars. But notice here it doesn't say material misstatements. It just says accumulate all of the misstatements. The reason that we don't knock out any misstatements by saying, oh, look, this is immaterial, we still pop it on the list, but we're going to step back and we're going to look at all of the misstatements together to see if there's anything that might be a trend or a pattern or something that we need to consider. So we have to evaluate the misstatements individually and also in aggregate form. Now, when I say aggregate, I mean that sometimes you might add all of the current asset issues together, all of the expense issues, all of the revenue issues, especially if there's segments or a lot going on there. And then you might say, okay, well, all of these in current assets are pretty small, but what I might find is that if they're aggregated, individually they might be less than materiality, but when you add them, they could be quite significant. We also need to consider the misstatements in relation to any previous year unadjusted misstatements. So if you did the audit last year and you noticed that last year it was a $50,000 understatement and this year it's a $100,000 overstatement, then you need to consider the swing between those years as well. So one thing that auditors will create is something called a summary of a list of misstatements, or it could be a schedule. It has a number of different names, but it's essentially a record of all of the misstatements identified during the audit process. So the many names could depend on the audit firm. I've seen things like a summary of unadjusted misstatements, and then of course after we negotiate adjustments, it'll become the summary of adjusted misstatements. There's things called schedules of audit differences, summaries of audit misstatements, as long as it's something along those lines. I'm going to add some samples of schedules of audit differences into the class notebook so that you can have a look at what they look like. But essentially, all firms have their own classification systems, but you'll see something like there is a type. So where it says here type, so factual, so there's clearly some issue that's not going to be contestable. Look, clearly you've made a mistake. This invoice says 5,000 and you've accidentally typed 50,000. That's a clear factual error. Where it becomes more tricky is there's a judgment. We're making a professional judgment. That often means, when it says judgment, that we're looking at something that is related to estimation. And ASA 540, which is the standard on accounting estimates, says that we need to look at sort of three things. It's the method, it's the assumptions, and we also need to look at the data. So if it's a judgment and we're looking at fair value, for example, then we're going to need to make sure that we can say to the client, look, we don't agree with your method. Here's the best method. Or you've made the wrong assumptions. Or you've used data, but it might not be the best data to use for this question. So judgment. And then the third one is projections. Oh, that's not a very easy color to read there, projections. Remember, projections are always going to be harder to persuade the client on because in a projection, you've only tested a sample of transactions. You haven't tested all of them. So in that instance, the more evidence you've got, the better that you might be able to convince them. Another way in which we could try and classify them could be the type, because it could be a dollar value amount. It could be a classification, like are we looking at a non-current versus a current item? Or it could be a presentation or disclosure note issue. Now you could use multiple categorization systems or tagging systems as well. The other thing that you might, or the client or the auditor might think about is materiality. Is this quantitatively material, so dollar value size, or is the item qualitatively material? Because some things we know, like related party transactions, may not be big in dollar value, but are qualitatively very important. So you'll have some way where you'll find a misstatement, you'll put it into, or you'll ask your supervisor to add it to this summary list. Now this list becomes really important because it is what we use to go to the client and to begin negotiating what adjustments they are going to make. So now we're going to look at negotiating audit adjustments with the client. And until I'd actually been on an audit, I read textbooks. And I was studying at uni, and the textbooks don't even talk much about the fact that management have to look at the schedule of adjustments that we're requesting and say yes, no, well, maybe, and there's a lot of back and forth. I just thought that clients went tick, 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 agree, no, 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 and then we just gave our opinion. Later on, from being part of audits and understanding the research, I discovered that negotiation is a really big part of trying to get these adjustments through with the client, because I can't change the financial statements as the auditor. I can recommend what management should do, but I don't have control. That is their responsibility under the Corporations Act, under the accounting standards, under the management representation letter that we're supposed to obtain under ASA 580. So this negotiation practice isn't something that's talked about in textbooks a lot, but there's been a lot of research, so I wanted to make sure that we've covered it. So what does ASA 450 say? It says we have to request, put the highlighter on here, request management correct the misstatements. Now, they can say, no, I don't want to do that. I think my number's right. I think your number's wrong. I disagree with your method or your assumptions or your data on some sort of accounting estimate. So if they refuse, then a refusal means that we might need to consider modifying the audit opinion, and that comes up in one of our other videos. So textbooks versus real life. Client in the textbooks, you say, hey, you make these changes, and they go to the ones that they want to do, yep, sure, tick, 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 and the ones that they want to do, oh yeah, I'm not going to change that one, I'm not going to change that one, and then we go off on our merry way about giving them the audit opinion. In real life, the client is going to say, yep, we'll make some changes, but for a lot of changes, they think what they have is correct. Now remember, the other thing that comes into play here is the agency theory. And that is that managers are self-interested. That means they are interested in their bonus payment, their executive stock options, their short term rather than the shareholders' longer term. So what they put together initially is what they think is correct. And so they're not so happy to make a lot of adjustments, and we need to figure out ways to try and convince them to make those adjustments for shareholders. So let's look at the audit negotiation process. And I've gone through here a lot of the research and I've condensed it down to what we see in these slides. So adjustments, I'm going to start with the left-hand column here. Adjustments will be more easily accepted by the client when they're based on clear mistakes or errors. That's really, really simple. If the mistake, got two numbers around the wrong way, or we added a 0, they're like, oh yeah, mistake, that's no worries. When they're based on projections with large samples, if they're like, oh yeah, okay, you covered 80% of the population and you've got this projection, then that you've got a better chance of getting that approved or management agreeing to make that change. Where you've got an independent expert verifying the auditor's judgment, and that's an expert typically that the client, whether it's a government body or somebody in the industry that they respect, an independent expert goes a long way to saying, look, it's not just us, the auditor, the independent expert thinks that an adjustment is needed as well. If you've got an effective audit committee, a strong audit committee that's focused on making sure that shareholders get the best value, we're steering the ship for shareholders, managers are considering shareholders, then there's a much better chance there also that management will work with the auditors to make adjustments. And whether a similar misstatement was made in a previous year, and I should add here, and adjusted. So if they made an adjustment in a previous year, they're much more likely to make an adjustment this year. Now, adjustments are more likely to be argued over when they're based on projection with small samples. Oh, you only checked this many, you could have made a mistake, there could be an issue. They're based on a difference of opinion, and this is where ASA 540 comes in and says, oh, well, this is an estimate, we're only giving our best educated opinions here. So where there's an estimate, you're expected to see a bit more pushback from the client. Therefore, disclosures that require judgment on how much to disclose. Where there's a dominant CEO and CFO, they're likely to dig their heels in, especially if there's no audit committee. If it's a smaller company that doesn't need an audit committee, a dominant CEO or CFO might say, yeah, no, don't want to make the changes. Or if they think they've got control over the shareholders. So dominant CEO or CFO also means that they're often majority shareholder. Now that's not going to happen in publicly listed firms, but it happens in smaller entities where they say, look, I own 51% of the shares, I'm the CEO, I don't want to make a change. So what sort of factors affect the auditor-client negotiation process? There's a whole lot of stuff, but here's the research condensed. So number one, why is an audit needed? If it's needed for a public listing, to get a loan, there's a reason that the client wants an unqualified, unmodified audit opinion, the big tick, then they're much more likely to play ball. Does the CFO or financial controller support the auditor's judgment? If we can get the financial controller or the CFO on side, then the CEO is more likely to come on board as well. What are the negotiation tactics used? There's different books and they even teach courses to audit partners on how to negotiate. What's the opening move that you should have? Whether the auditor is at the beginning or the end of their 5-year rotation. At the beginning, while the auditor and the client are still trying to feel their way out, the client might be more reluctant to listen to the auditor. They don't know them, they don't have that relationship. Towards the end, the client might go, yeah, okay, right, we've worked with this team for a while, we're confident in their recommendations, we might be more willing to make those adjustments. The client, on the other hand, may say, well, I've got to get rid of this auditor at the end of the period anyway, I'm just going to dig my heels in. Whether it's the first year a firm audits a client, so again, sort of linked to whether it's the beginning or the end of their rotation, the first time you audit a client, again, it's that feeling out period of they don't know each other and trying to make those decisions. The quality of the audit-client relationship, so if it's always been a combative, quite explosive or tense relationship, then you're less likely to get good outcomes from that negotiation process. If the client also provides, if the auditor also provides non-audit services, there is a lot of theory that talks about how self-interest is going to come into play and there's going to be a self-interest threat for the audit partner. However, the statistics of hundreds of audits tend to indicate that it doesn't come into effect. Auditors, if the client says, if you don't give me the unqualified audit opinion, unmodified audit opinion, I'm not going to give you this consulting, then in role plays and experiments, the audit partners have said, no, I'm still going to stick to my APES 110 independence requirements. And the experience of both the audit partner and the client's main negotiator. With a junior partner or a new partner or a director who doesn't have that experience, who doesn't have the training and the relationships with the client, then we're more likely to let the client get away with more than they should. There are sort of two ways of thinking about audit negotiation. Do you go with the carrot of the enticing and this is good for shareholders and everything that's positive about making sure that your client's financial statements are as accurate and reliable as possible. And the other option is the stick. And the stick is essentially a modified audit opinion. Now, a modified audit opinion is a stick because when you get a modified audit opinion, typically you'll have a negative share price reaction. That decline in the share price hits executives because it typically will devalue the executive stock options that they hold in their employment. So that becomes the big issue here. Now, I actually haven't realized I didn't have anything in the slides about how we actually negotiate the adjustments. So I'm going to write some material just here. So imagine that we have a misstatement of 100,000. That's the K there. But let's say materiality is 70,000. So that means anything higher than 70,000, we need to consider adjusting. So the big question here is, what is the minimum adjustment we would accept from the client? Now, essentially, in this instance, the client doesn't want to make any adjustment, right? You could assume, unless it's a clear clerical error, that in 99% of cases, the clients don't want to adjust. So their desired adjustment is 0, absolutely none. Ideally, we would love them to make all of the adjustment. However, the minimum adjustment that we're going to accept from the client is going to be 30,000. Why 30,000? Because that takes that misstatement down to a value of 70K, which is our materiality threshold. Now, we also need to think about, would this be qualitatively important for us, even though we might have, if we've only accepted a $30,000 adjustment, we might need to think, well, if I have 70,000 still uncorrected, does that add up with any other adjustments in that class of accounts that might create a bigger issue? So the minimum we would accept in this situation is 30. The maximum we want is 100. But sometimes it's also a matter of trade-offs. I had a partner who used to say things like, okay, well, we have all of these misstatements down here, and here are the really big ones, right? Here are the ones that are like 7.8 million and 5 million. And then I've got this one down here that's 10,000. And they might say, oh, well, look, if you make these adjustments up here, I might forget. I'm not going to make you change these smaller ones down the bottom, these ones that are lower than our materiality. Now, obviously, we don't want to tell the client that. Here is the ones that we definitely can not even worry about. But we could use smaller misstatements as part of a bargaining process where you say, oh, we'll make these adjustments and I won't require you to make these other adjustments. But in making those adjustments, know that the client gets a compromise set of financial statements. It's not what we think is the fully audited amount. It's what management has been willing to change and what we think is acceptable. So it is still possible that a financial statements or a set of financial statements are created that still have uncorrected misstatements in them, that if they're major and they're material, we're going to deal with in the audit opinion and we're going to modify the opinion. But if we think overall the financial statements are okay and we can give them an unmodified opinion, then they're still going to sit there. We need to think about that the next time we come around to do an audit in case they start to aggregate and to compound. So let's look at preparing the audit opinions. And here we've got ASA 705, 701, 706. And I forgot to add on to the title slide there, ASA 701. So let's look at an organization of the standards. So you've got standards that are about the opinion itself. And those standards are 700 and 705, okay? Then you have standards about disclosures. And these are disclosures the auditor is going to make, which is 706. Then, I guess, and it's not related to the opinion, but more related to the audit process itself, is, where should I put 701? So this is sort of disclosures related to the opinion. And then you've got disclosures related to the audit process, which is ASA 701. And you might think, like, why is 701 sort of separate? It's just the number that was allocated. This is only a recent standard. You need to make sure that you can read all of these standards, that you've got a summary of them, that you understand which standard in which situation, and which audit opinion in which situation. And it's really important as well that you know your paragraphs when it comes to these particular standards. So with ASA 700, we have to form an opinion. We can't get away with forming an opinion. Our engagement letter, which is our contract from ASA 210, says we have to give an opinion, as well as the Pacific Acceptance legal case that says we have to have an opinion as well. So what sort of information must we use to prepare our opinion? Well, number one, we have to ask, do we have sufficient appropriate evidence? That comes from ASA 500. Then we have to ask, do we have any uncorrected misstatements? Remember, I talked about those in just the previous topic. And is the financial report free from material misstatement overall? So that's stepping back, looking at the big picture and saying, does this look right? Does this look like it matches the economic reality of that business? And are the disclosures appropriate? So if we have sufficient appropriate evidence, we don't have any material misstatements that are still existing in the accounts, and we think disclosures are appropriate, then ASA 700 is going to give us, or it's going to tell us, to issue an unmodified opinion. And that opinion is the big tick. That's everything is true and fair. Now remember, the company might still be on a downward trajectory, but as long as they're telling the truth, they still get an unmodified opinion. So, I skipped a little bit ahead here, but we should have an I can never spell this one. We should have an unmodified opinion when the auditor concludes that the financial report is prepared in all material respects, again, in accordance with our applicable financial reporting framework, which is our AASB. So what we're saying here is sufficient appropriate evidence, tick. Any uncorrected misstatements are immaterial, correct, and prepared within the AASB's, correct. So if those things are correct, then we can give it a tick. We're giving an unmodified opinion. Now, sometimes you might also hear it called an unqualified opinion. We're trying to move away from the term unqualified and using the word unmodified now. So in an exam situation, you need to make sure that you use the word unmodified, not unqualified, because that is older terminology. Now, modifications is where something is not correct. So remember, we talked about having sufficient appropriate evidence, everything meets the audit standards, disclosures are okay. When something is not okay with those three, we have to go to a modified audit opinion. So ASA 705 talks about modifications, and all of the options in this box over here are modifications. And this little table comes from ASA 705. So make sure that you've copied that into your notes. Now, we're going to look at this in two particular steps. Step one is over here in the orange, all right? So we're always going to do this step first. Then we're going to worry about this blue section over here as step two. So always worry about step one first. So there are two reasons why we might modify the financial statements. Number one is there's a misstatement. That is, we disagree with management about some number or some disclosure, okay? So that's when the account doesn't meet the assertions, okay? So I'm just going to do a little arrow up here. All right. Does not meet the assertions, and management refused to change. So this sometimes is also called a disagreement with management in some of my older YouTube stuff if you're looking at that online. The second reason why we might give a modification is because we've had an inability to obtain sufficient appropriate audit evidence. Now, that could be the client refuses to give it to us, or the evidence was destroyed, or something else happened, you know, all the databases were corrupted or something like that. It could also be in the current environment where we might not be able to, for example, check the existence of inventory. We might have to say, look, we can't get sufficient appropriate evidence on the existence of inventory, so I'm going to have to modify the audit opinion. All right, so it's either like, you know, something is not possible, but if we did have that problem, we would tell management straight away. We wouldn't wait till the end of the audit. We'd say at the planning stage, well, it's going to be a little bit difficult to check the existence of inventory. What do you think we could do so that we don't have to give you a modified audit opinion because of this? So the first step is there a material misstatement, or is there an inability to obtain sufficient appropriate evidence? Now, the next step is that we need to move on to that blue section about the pervasiveness of the effect, or the possible effects on the financial report. And pervasive is this really unusual word. So this is only for things that are material, all right? Material, that's really important. But you'll notice the next part says not pervasive or is pervasive, okay? And so I'm going to use and I have some animals that I use to explain this particular process. So material but not pervasive is sort of like this little dude here, and you can't laugh at my art because I'm not very good, but that's meant to be a snail, right? Or a slug, yeah? It's one account. Imagine a snail doesn't move very fast. So when I have an issue, whether it's a material misstatement or an inability to obtain sufficient appropriate evidence, and it's small, right? Because a snail is a small thing, and you sit him on the financial statements, he's not going very far. You know, he's just staying in one spot. Then I'm going to provide, in that instance, a qualified opinion. So I've got a disagreement with management. They don't want to change something. It's important, but only one thing in one small area, I'm going to go qualified. If I couldn't get sufficient appropriate evidence and it's only a small thing but still material, I'm going to give a qualified. The other option is the right-hand column, which says material and pervasive. And I'm going to use two particular, how many legs? 1, 2, 3, 4, 5, 6. Never can draw an octopus with enough legs. All right, so here's my octopus. And think about an octopus. You see an octopus on the financial statements, and its tentacles go everywhere, yeah? So material and pervasive, if it was the financial report is misstated, so we have disagreements with management, we have uncorrected material issues, and there's a lot of them, and they spread throughout with the octopus's tentacles, that's pervasive. In that instance, I'm going to give an adverse opinion, okay? Now, what if it's the second row down? If it's I can't get enough evidence, and there's so much evidence I can't get, I'm actually going to give a disclaimer of an opinion. And a disclaimer of opinion is actually no opinion. I am actually saying I cannot give an opinion, okay? So think about this. We've got the octopus, we've got the little snail. Now, the other instance in which we might have a pervasive issue is if we have, and you'll have to, I'm going to sort of draw over my slides here. This is meant to be a really big whale, right? Imagine the blue whale. The blue whale is the biggest whale in existence. You might have one misstatement that is so big that it overshadows everything else, even though it's only contained to one area. In that instance, the blue whale is also considered pervasive. So you've got two options for pervasive. Think about the octopus with its many tentacles or the massive blue whale. For material but not pervasive, imagine, I've got my little slug there, or if you wanted to go even smaller, like a little ladybird, it's just one small error, but it's not pervasive, okay? So students will tend to jump to pervasive really, really easily, but think about the octopus. So what exactly does pervasive mean? I thought I'd go back into ASA 705 and the definitions. This actually comes from the definitions here. It's to describe the effects on the financial report of misstatements or the possible effects. So pervasive are those that we think are not confined to specific elements, so really like across a lot of different areas. If they are confined, could represent a substantial proportion, really, really big, or if it's just disclosures are fundamental to users' understanding of the financial report. So if it's missing lots of key disclosures, we could also say pervasive. So think about the octopus, the whale, and the snail, and you should be right here when it comes to audit opinions and which of those types. Now, ASA 706 is when we have emphasis of matter and other matter paragraphs. And this is sort of like going to McDonald's and saying, okay, I've got my meal and then I'm going to add a dessert on top of that. So the emphasis of matter and the other matters are like add-ons that we can add to any audit opinion. And it's for when we want to draw attention. So there are two options. The emphasis of matter is for when stuff is already in the financial statements, and the other matter is for other items. So ASA 706 is the standard there that talks about the definitions of it, and neither adding an emphasis of matter or another matter paragraph are called modifications. So you can add an emphasis of matter to an unmodified opinion, so an unmodified with an emphasis of matter. You could also add an emphasis of matter to a qualified or an adverse opinion. As long as it's about something else, it's not the reason why we qualified it or we went adverse in the first place. So it can be something else. But really, we're saying information's in the financial statements, but hey, like, have a look down here. We're highlighting something for the shareholder. So let's look at the difference between the two because it can be a little bit tricky. So the difference is that the emphasis of matter is for matters already disclosed in the financial report. So if management are already disclosing something and we're saying like, hey, management said this, but we want to remind you, that goes in the emphasis of matter. If it's for something not in the financial report, we're talking about something that's important but not reported in the financial report because it's not required under the AASBs, then we add it into the other matter paragraph. I actually went through the last few years of financial reports available for publicly listed companies, and other matter paragraphs are really rare. I couldn't find any recent ones that I could actually show you, but I can show you some emphasis of matter paragraphs. But they're really about making sure that, yes, management have said stuff, especially in the emphasis of matter, but quite often it's dug right down in the notes, so we're bringing it right up front in our audit opinion. For the emphasis of matter, it's mostly for subsequent event disclosures. In the old days, going concern also used to be in an emphasis of matter paragraph. Now it's in its own section, and I'm going to talk about that as well. Other matter paragraphs are quite often where other information is contradictory. So if the company is just going down the toilet and the front glossy part of the annual report says, oh, everything is great, company's going so well, we're going to survive. But then in the actual financial statements, they're like, oh, the company has some serious going concern issues. That's where we'd raise it, potentially in an other matter paragraph, because that information is conflicting. So what do you do when there's a going concern issue? I'll make sure in the class notebook there's lots of examples of regular emphasis of matters that you can look at. COVID-19 is going to become a huge subsequent event emphasis of matter point, I think. But in terms of where there's a going concern, and I realize I didn't actually put a table down here so that you could see this. This actually should be some lines here, because that really needs to be a table. But where management make the disclosure, we give an example here is a paragraph by the auditor about the material uncertainty. So, look, it says here, we draw attention to note 2 in the financial statement. So we're saying management have already disclosed it, but here we're reinforcing this. And they actually get quite specific. They had a net loss of $1 million and they had net operating cash flow for the year of less than $1 million. There's a significant uncertainty. Now, what happens if management do not make the disclosures in the financial report? If management don't make the disclosures, then we're going to have to modify the opinion. And depending on the severity of whether going concern is appropriate or not and whether there's a material uncertainty or not, your options are going to be to go with qualified or with adverse. And that's all covered in that flow diagram from ASA 570. Here's another example of a material uncertainty paragraph. This is one prepared for 9 Spokes International that I just found through one of our databases. And it says, well, look, yep, there's a material uncertainty about going concern. They had a loss of $9.3 million, cash outflow from operating activities of $9.4 million. So they made $9.4 million in cash, but they still had losses. And look at this one. Only has sufficient cash for a further 4 months from the date of the signing of these financial statements. Really big issue here. They're going to need to secure a deal with another bank or raise capital. But you know, there's a significant doubt on the group's ability to continue as a going concern, but they've not modified it. So they still think the going concern basis is appropriate. Management have made the right disclosures, but we're just saying, look, big flag, be careful. I mentioned we have a new standard, that's ASA 701, about key audit matters. So ASA 701 is a relatively new standard. It came into effect in 2019, and we've got a whole range of information now about what companies are talking about or what auditors are talking about, but it was an international standard that came out in 2015. And what's really important for us is that the UK early adopted key audit matters, and there was a lot of great information about what auditors should do. The US has a similar standard, but they use the word critical audit matters. I don't know why they used critical instead of key. They just had to be different there. But why do we have them? This is really important. The purpose of communicating key audit matters is to enhance the communicative value of the auditor's report. So that's saying that the audit report is a communication device. We're giving information. So we're trying to enhance the value and taking away the idea that, the audit is just this regulatory thing. It's like a stamp. We have to have it. We're trying to provide people with more value. And it does this by providing greater transparency about the audit that was performed. So really, this is a process that's giving us insight into the auditor's thinking. All right. So this is their thinking and their judgment processes. So we're trying to peel away the black box that is normally audit judgment, and we're actually trying to explain to the shareholders, the users of the financial report, this is how complicated auditing is, and we're going to look at some examples. So here I've taken an excerpt from the IAASB, which is the International Auditing Assurance Standards Board. This is from 2016. But really, we start with a funnel process. So what we have, starting at the very top of the pyramid, the reverse pyramid there, is matters communicated with those charged with governance. So these are like things that we think areas that are going to have higher risk. Then comes down to matters that require significant auditor attention. So imagine from ASA 315 that these are going to be the significant risks. Okay, and then distilled down further from the significant risks is going to be our key audit matters. So these are the things where there's a higher risk of misstatement. It's probably a significant risk. And we think that more audited judgment has needed to be used on this particular account, which means that there's a greater risk that we might make human judgment errors or that there's a disagreement of opinion. So key audit matters are ones where we have to use our judgment the most. Now, there might be a significant risk that exists because of a control weakness or because of a quirk in the industry that we can confidently gather audit data to be able to be sure of the reported or the accurate amount that should be included. But sometimes where there's more professional judgment, we have to use more methods, assumptions, analyze more data, then those are the sorts of things that we're going to see in our key audit matters. Potentially under our current COVID-19, COVID-19 situation, we may see things like evaluating going concern fall into key audit matters for 2020. Now, we haven't had a lot of annual reports in this area yet, but that's something we'll be keeping an eye on. Here is some key audit matters for a company we probably all know really well, the Woolworths Limited. So that's our Woolworths supermarkets, their liquor outlets, etc. So it's a bit small, but I'll also link you in the class notebook to their actual annual report. So you can look at all of the key audit matters, but you'll see here there's a key audit matter, and you'll also see the other column, the scope, which is how our auditor responded to the key audit matter. So for example, here, there's a key audit matter around, and I'll see if I can highlight this, lease provisions and asset impairment. All right. And then here, what they're doing in the procedures is that they're actually telling you the steps. We made sure we understood the processes. So it says here we're understanding the processes of the group. We looked at the methodologies and we looked at the accounting standards. We looked at the assumptions in these lease provisions and asset impairment tests. We went and we looked at historical accuracy of forecasting cash flows. We used internal specialists from the audit firm to make sure we were doing the right thing, using the right models. We even did sensitivity analysis to check that as other things changed, how did the model hold up? We looked at the mathematical accuracy, so they did recalculations. So here, what they're saying is we have a really tricky part of the audit, and here's why it's tricky. Here is why there's more risk. And then in the other column, they're saying, here's what we did about it. So one of the benefits of having key audit matters is that it also helps auditors be more explicit in their audit planning. What are we going to do? This is probably going to be a key audit matter. Have we done enough so that when we explain this to shareholders, we feel confident in our work and that we've determined that the audit opinion is the correct one? In looking at this next one, it also says, again, leases, but this time lease disclosures is the issue. And they said, oh, well, there's a new lease standard. AASB 16 is a new lease standard. And so we've done this, and there's been this change. There was an increase in lease assets and lease liabilities of $12.2 billion. That's a pretty big amount. And a change in lease liabilities of $14.7 billion. So they've said here, this is a big thing. There's a lot of key judgments that come into play. So here's what we did. Here's our procedures. We looked at a process. We looked at accounting policies. Now you'll notice that the structure is sort of the same. They've talked about understanding processes and controls. They've talked about accounting policy. They've talked about making sure they understand the business, that we looked at any assumptions used. Here, this is a bit of a different one compared to the previous one. They looked at a sample of leases and the original contract terms or other supporting documents. They looked at the completeness of the calculation by recalculating. So here, if you're a student, this is also a really great place to gather information about how we might gather evidence on different parts of the accounts, different risks, by looking at what the auditors are actually telling us that they're doing. So this is a lot more transparency. Before key audit matters, we didn't tell anybody anything about how the audit was done, except that we followed the audit standards and we followed the ethical standards. This is now a lot more detail. Now, of course, we're not going into detail for every part of the accounts, but for the key audit matters. Some companies might have 10 key audit matters, other companies might only have 2 or 3. It's really dependent on the individual firm. There is no ideal number of key audit matters, but I can imagine in 2020 we're going to see an increase in the sheer number because of the difficulties associated with estimating, with gathering evidence, and with analysing going concern as a result of COVID-19. Now we come to our final section, which is on the management letter. Now be careful because this is not the same as the management representation letter, which we looked at in ASA 580. Remember, the management representation letter is the letter that management sent to us to confirm any verbal evidence that they've provided us with, everything that we need, and that they understand that the financial report is their responsibility. Instead, let's look at the management letter. So what is the management letter? Well, this is a letter between the auditor, so it's something that the auditor prepares and sends to management of the firm, or more accurately, according to the auditing standards, those charged with governance, which we often abbreviate to TCWG. So paragraph 16 of the standard says, I should communicate with them. Earlier on in paragraphs 14 and 15, it says we need to talk to management at the planning stage as we're doing the audit, but we also need to converse with them at the end. Now, who exactly is those people who are those charged with governance? Well, it's a few different parties. It's quite often your executive within the organization, so CEO, but in bigger firms, more likely the CFO, and usually it's also your audit committee. So we have to communicate with them some information. So we have to talk to them about, and part A says, significant qualitative aspects of their accounting practices. So remember, the first set of notes in any annual report after the income statement, balance sheet, cash flow is the notes to the accounts, and note 1 is normally about accounting policies. So are they making the right accounting policy choices? This is really also helping communicate with them about important things we need to know about for the audit. So at the end we say, look, here is a summary of your accounting policies, here's how they're displayed, we're just confirming with you our understanding. We also have to talk to them about, in B here, any significant difficulties encountered during the audit. Did we have any limitations of scope? Were there any people that were reluctant to give us evidence? Did we have any significant disagreements in terms of negotiating any adjustments? So this is usually a formal report that's written after we've already decided on our audit opinion and we've already had that negotiation process between the client and the audit representatives. So we have to talk to them about any difficulties. Quite often the audit committee is not involved in that negotiation process around adjustments. So if we did have some significant issues, we tell them at this particular point. Now, part C says, unless those charged with governance are involved in managing the entity, so typically you might have somebody, we might also be presenting to the CFO, but audit committee as well. What significant audit matters did arise during our process? Again, those significant difficulties, any significant adjustments that we needed to make, and we've already talked about written representations in ASA 580. Now, paragraph D here says, what is the form and the content of our auditor's report? So we're telling them, here is what's going in the report, we've already signed it, and then any other significant matters that might have arisen. So you may have identified potential issues that you might need to notify law enforcement about, additional risks in some areas that might be outside of the traditional audit, but you wanted to provide that information to them anyway. This process is how auditors try and increase the value of an audit, because quite often management will say, oh, look, the audit is something that we have to have because the Corporations Act says we have to, or some other regulation. So we provide value by trying to give management more information about our process. What did we find? So ASA 265, which is a standard about communicating internal control deficiencies says that we also need to communicate with those charged with governance. So remember, back to our systems of internal control, where we have our information system, we have our control environment, risk assessment, control activities, monitoring, information systems and communications, and out of all of that information we generate our control risk assessment. And generally, as part of that control risk assessment, we identify any weaknesses in the systems of internal controls, where there are gaps. So ASA 265 says what we should do is, if we've identified deficiencies in internal control, I should consider whether they constitute significant deficiencies. Do they increase the risk of material misstatement, of error, the potential for fraud? And if we do find some, I have to communicate in writing these deficiencies in internal controls. So when I write my management letter, I will also include these deficiencies in internal controls. Now, what exactly do we have to include in that letter? Paragraph 11 says I have to describe the deficiency and the potential effects. So what are the potential errors, fraud, misstatements that may arise from that particular deficiency? Like, at a very expensive jewelry store, there is no security guard to check people coming in and out. Customers might be able to access all the cases with the jewelry. They're not behind a lock and key. Well, there's an increased risk of theft there. So we have to talk about the deficiency and their potential effects. Now, I don't here suggest the solution. Why don't I suggest potentially what they could do to improve internal controls? Well, the thing I need to be careful of is the risk of self-review when it comes to our independence threat. So I might give them a range of options. Look, you could do this, we've seen this, we've seen this, but I should not say to the client at this point, you should implement X specific control. So I can't ask them to implement a specific control, because then next time when I review those internal controls, I'm much more likely to say, tick, that control looks fine because they're doing the control that I suggested to them. So is this a real letter? We call it a management letter. Is it a physical real letter? Yes, but more often it is quite longer. You know, a letter I would imagine is a 2 or 3 page thing. Quite often these are longer reports, our management letters. And many auditors will also give a presentation to those charged with governance. Now, why do we think about doing a presentation rather than just sending the letter? Well, we want to give a presentation because it's the last chance to clear up any confusion. Sometimes somebody might have a question about a point that they might see in the report or something on our slides, and that gives us the ability to explain in more context rather than perhaps the client getting upset about something or having a misunderstanding about something we've done or that information that we're providing to them. This is also the last chance to clear up any confusion about the audit report. So if they go like, oh, why did we get a qualified report? Is qualified a good thing? This is our chance to clear that up with them in case those charged with governance are not as financially savvy and audit reporting savvy as they should be. So what do we hope to achieve with this sort of communication? Well, number one, we want to see improvement in internal controls, because remember, if we can improve internal controls, then what's going to happen next year is control risk is going to go down. That's going to lead to increased detection risk, and that means that our audit is going to be more of a controls-based approach. Now, why is that better? Well, a controls-based approach is better because it is less expensive. So you typically do less testing, less substantive testing, which can be very expensive. So if we can ask our clients or get our clients to improve their internal controls, but we can still charge them the same price on the audit, or perhaps charge them a little bit less, we've got a chance to make potentially a little bit more profit. We're also likely to be more profitable in the second year of an audit because we know what's happening. We spend less time searching for basic information because we have that understanding of the firm. We know the people. Often audits second, third, fourth years. Fifth years are much more efficient than in the first year. The second thing that we hope to achieve is a better understanding of the audit process. Sometimes you still will encounter clients who don't understand what an unmodified audit opinion is, what an emphasis of matter paragraph is, what going concern is about. So the more that they understand our process and what we're asking for, then hopefully they're also likely to be more cooperative. They'll give us evidence more quickly. They can sometimes anticipate what we're asking for as well. On some audits that you might have done for a few years, when you turn up on the first day, the client already has a packet of information for you saying, here are the things you asked for last year, here you go. Again, that can help us get our audit moving a lot faster, which means a smoother audit next year, less things to worry about, hopefully less misstatements. If we tell clients, look, here's an accounting policy issue, we've argued over it. Next year they agree to make a change, and then that makes our accounting process a lot smoother and a lot less stressful. So to sum up, over the entire topic, we need to understand what misstatements require, which ones require adjustment, and how to approach management. Do we just go like, you should change these or I'm going to give you a qualified opinion or an adverse opinion, or do we try something else? We need to know how to determine which opinion to give. When do I give an adverse? When do I give a qualified? How do I know what pervasive means? These are really critical things. And the other thing I would also recommend is also know your standard references here. Okay, so which standard says unmodified opinion and what paragraph is it? If I have a disclaimer of opinion and I have, well then what standard? ASA 705, what paragraph in ASA 705 tells me that? And then in communicating our audit findings, it's important for our current and our future audits so that everybody's on the same page, there's no misunderstandings with our audit opinion and what that potentially means to management of the firm and also to the shareholders. So that's it. Congratulations. Yay. We've reached the end of the topic and of the course. So thank you for coming along with me on this journey. Of course, now we have study for the final exam. I encourage you to use all of the resources, the Auditor Day study program, watching all of our videos again, going back and doing all of our quizzes and additional materials that are provided in the course. Thank you, and we look forward to seeing you in the exam and also at a graduation ceremony soon.